be over the weekend. It is raining in Juba. In the investment decision, we are looking at the uncertainty. Investment decision and the uncertainty. I don't know whether you can see my screen. I am sharing my screen. Can you see my screen? Yes, yes. Yeah, I see someone. Yes, I can see that you are responding. Good. That's fine. That's fine. That's fine. So I want us to just start. If I'm clearly visible, I'm clearly audible. I want us to look at the replacement decision. The replacement decision. And the replacement decision, it is about replacing, it is about replacing an existing project with a new one. So we say that this decision, the viability test is carried out through the cost-benefit analysis. The cost-benefit analysis. So the decision to replace an existing asset with a new one or an existing project is carried out, or that replacement means you abandon an existing project, then you take a new project. It is carried out at a cost-benefit analysis, and we determine whether the replacement decision is viable or not viable by considering the incremental costs and the incremental cash flow. When it comes to the replacement decision or evaluating the replacement decision, we need to determine the relevant cash flows. So what cash flows do we consider in the evaluation? So we say that steps in replacement analysis. Steps in replacement analysis. Number one, we determine the incremental initial capital. Determine the incremental initial capital outlay. When you talk of the incremental initial capital outlay, when you are making a decision to replace, you will dispose of an existing machine, then you acquire a new machine. That means, in this case, there is that incremental, and this is the way we go about it. We say that there is the cost of the new machine, the cost of the new machine, let me say that the cost of new plant and machinery, the cost of the new plant and machinery, we are saying that here we have the cost of the new plant and machinery. Now, this machine, we add incidental costs. Incidental costs. The incidental costs are the costs that are incurred when you are taking or we are acquiring a new machine, e.g., import duty. You can have something like installation. costs, installation costs. You can have freight costs, the insurance in transit. You take all these costs that are incurred at the time that you are acquiring a new machine, you sum them together. That will give you what you call the depreciable cost, the value that will be depreciated, depreciable, the depreciable cost. The depreciable cost is the cost of the new machine to be acquired. If there was nothing else, that is the only cost that would be considered. But remember, we are undertaking a new project that may even be more efficient than existing one. So at this point, we less disposal proceed, disposal proceed, disposal proceed of the old machine, plant, or let me call the old project. The old asset will have to be disposed. That will bring a cash inflow. Remember, you need to purchase a new one, but you are disposing of the existing one. There is the cash that you get from the disposal of the existing one. That is a cash inflow. You minus it. The other thing is that at the point of sale, of disposal of the old machine, there is either the gain or loss on disposal of the old machine. That will attract taxation. So we say that in case the disposal of the old machine is at a profit, we will dispose it at a gain. That gain is taxable. So we say that we add, this is a cash inflow, tax payable. Tax payable on disposal gain. Disposal gain of old projects. When the old project is disposed of, there is a gain or loss. Alternatively, we can say that, or we less the tax saving on disposal loss. Tax saving on disposal loss of old machine. If we do consider is that when you are working on a new project, you want to get a more efficient project, you can add, you could be required to have the incremental net working capital. Net working capital. Someone asked a question last time when we were looking at the investment decision about the working capital, the net working capital. When you are undertaking a new project, you could be required to invest more money in the net working capital. When you look at all these, this is the point where we talk of the difference is the incremental initial capital. The incremental initial capital, and this is what we'll be looking for, like that. The incremental initial capital. Let me have it like that. That is the first step. Determine the incremental initial capital of the replacement decision, where we consider the cash relating to the existing asset and the cash flow relating to the new asset. I don't know whether someone has a question on that. So let me see whether someone has a question so that at least we move together. If there is a question, okay, someone is asking at the end, give tip this paper because it's very hard for sure. No, don't say it is hard. It is friendly. Yeah, so we will discuss that. We'll discuss that. I'm with you even tomorrow. Someone is asking about question August 2021. Yeah, remind me when we are done. At end, give tips. Okay. So we will discuss. We'll discuss those. So the thing is to determine the cash outflow when undertaking a new project. Now, that part of the cash outflow, we need to ask ourselves, when you are determining, when you are undertaking a new project, what is that need to be done for you to determine the initial capital outlay? And the initial capital outlay is based on the variable as I have given them. And I think I will give an illustration. This is the illustration we'll move with to the end. So we say that a farm is considering replacing a machine that was acquired 3 years ago at a cost of Rwandan francs, let's say 10 million Rwandan francs. The machine was estimated to have an economic life of 8 years. 8 years with a salvage value of 400,000 Rwandan francs, 400, or let's say 4 million. The machine was to be depreciated on a straight line basis. Then we say that the machine can be disposed of immediately at this machine was bought at 10 million. It can be disposed of immediately at 8 million Rwandan francs. 8 million. So we are told that this machine could be disposed immediately at 8 million and replaced with a new one, costing 15 million Rwandan francs. Rwandan francs 15 million with an installation with an installation cost of let me say that of 3 million. With an installation cost of 3 million. The new machine will have an economic life of, now we are told that the old machine was expected to have 8 years. It has been there for 3 years. For the purpose of the evaluation, the remaining life of the old machine and the life of the new machine should be the same. So an economic life of 5 years. It is expected to have an economic life of 5 years, and salvage value of, let's say that it will have a salvage value of 6 million. It is expected to have a salvage value of Rwandan francs 6 million. That is, if the new machine is to be undertaken, it is to be acquired to replace the existing one. Then we say that the tax rate is 30%. The tax rate is 30%. The tax rate is that percent, and the farm expect to have or to experience an increase in trade receivable by 2.4 million Rwandan francs, 2.4 million, 2.4 million, comma, the inventory to support the operation of the new machine will have to increase, will have to be increased by, let me say that it will have to be increased by 1.8 million. Or let me say 1.8 million. 1.8 million, like that. So this farm, let me give it Rwandan francs, 1.8 million. The farm payables, the payables will also increase, by 2.2 million. 2.2 million Rwandan francs, like that. Now look at that illustration. Then you say that required determine the initial capital outlay. Determine the initial capital outlay. So let us read through the question together. I hope everyone can see the question, can see my screen well. We try to look at this illustration because these are the things that you get in a question. Okay, let us get to that. I see people asking some question. I will address them. We are told that from where the question starts, illustration. A farm is considering replacing a machine that was acquired 3 years ago at a cost of Rwandan francs 10 million. The machine was estimated to have an economic life of 8 years with a salvage value. This is with a salvage value of 4 million Rwandan francs. The machine was to be depreciated on a straight line basis. The machine can be disposed of immediately at Rwandan francs 8 million. It can be disposed of immediately at Rwandan francs 8 million. With a new one costing 15 million, with an installation cost of 3 million, the new machine will have an economic life. Will have an economic life. This is an economic life. Will have an economic life for 5 years and a salvage value of Rwandan francs 6 million. The tax rate is 30%, and the farm expects to experience an increase in trade receivable by Rwandan francs 2.4 million. The inventory to support the operation of the new machine will have to be increased by Rwandan francs 1.8 million. The payables will increase by, that is, trade payables will increase by 2.2 million. Required, determine the initial capital outlay. The first thing, or if we could say first things first, we need to determine whether the disposal of the new machine is at a gain or a loss. So I will say the cost of the old machine. The cost of the old machine was bought at how much? We are told that it was bought at 10. Then we less depreciation, less accumulated depreciation. We less accumulated depreciation to date. This is equal to, it is 10 million. We divide this by, it was estimated to have economic life of 8 years. We multiply by, it has been there for 3 years. Oh, sorry. Remember, we are given a salvage value of 4 million. So we minus 4 million. We minus 4 million like that. 10 million minus 4 million, divide by 8, multiply by 3. Can someone give me that figure? Please share that figure. Someone to share with that the accumulated depreciation. Is it there's someone who has given 7.5 million, another one has given 225? Is it 2250? Can we confirm that? 10 million minus the salvage value. Yeah, I see a majority giving 2250. So I'll put the 2250 here. I see the majority got 2250. $22.50. So what is current net book value? Net book value. 10 million minus 2250. How much is that? Is it okay? Someone to give me, please give me the answer. 10 million you minus 7750. 7750. See, that is what we have 70, 7, disposed. The net book value, you said it is 7750. The resultant difference is the gain on disposal. On disposal, the gain on disposal, and I think the gain on disposal here is 250. The gain on disposal is 250. Now, once that has been determined, let me underline this. I also underline this like this, so that at least it may look better. If that is the case, we are told that tax rate is 30%. Tax on disposal gain. Tax on disposal gain. This is equal to 30% multiplied by 250. Someone to give me 30% multiplied by 250. How much is that? I hope that gain is correct. If it is correct, how much is the tax on disposal gain? Is someone saying 75,000? This is 75,000. Is that correct? 75,000. I believe that is what you have. Now, we need to determine the initial capital outlay. Then initial capital outlay. We say that initial capital outlay. The initial capital outlay. Let's get, we say that cost of the new machine the cost of the new machine is going at 15 million. Is going at 15 million. 15 million. Then we add incidental cost. Add incidental cost. The incidental in this case is installation cost. We are told that this machine will be installed at 3 million. Like that. Whatever we get here is the depreciable cost. The depreciable cost. This is 18, if I'm not wrong. We say that we will dispose of the new machine, the old machine. Let me try to squeeze this one so that at least it can be well visible. Yeah, let me try to have it this way. Good, like that. We have the depreciable cost. We dispose the old one, so we less disposal. Proceed of the old machine. The old machine will be disposed at 8 million. Will be disposed at 8 million. The difference, we have the difference, then we add tax on disposal gain. We add tax on disposal gain. We've said that the tax on disposal gain is 75. Like that. Then from that point, we need to add incremental net working capital. The incremental net working capital, we got the net working capital. We are told that a firm is considering repricing. Down there, we are told that the salvage value is 6 million, the tax is 30%, and the firm expects to experience an increase in trade receivable by 2.4 million. Inventory to support this is 1.8 and trade payable is 2.2. Then incremental net working capital, here I have a receivable. The receivables will increase by 2.4 million. Then I have, oh, sorry. I have inventory. The inventory will increase by 1.8. Then I have the payables. The payables will increase by 2.2. So what do? I minus the payable. Like that. I minus the payable. How much is the net working capital? Incremental net working capital. Incremental net working capital. Can someone give me 2.4 million plus 1.8 minus 2.2 million? How much is it? 2 million. Good. I see 2 million. We need to invest an extra 2 million in the working capital. Is there anything else that I have left out? This is the initial capital outlay. This is the incremental initial capital outlay. Now, someone to give me this 15 million plus 3 million, that was 18 million minus 8 million plus initial capital. How much? Someone is giving me, is it 7, sorry, how much? 12,075. There's someone who is giving 12,075. Another one is giving, I think, 10,750. Which is which? 12,075 is given twice, is given thrice. So I think the answer that is given by a majority is 12,075. Let me use 12,075. That is the initial capital outlay. Unless someone has a question, that is where to determine the initial capital outlay. When you are undertaking a new project, you determine the gain or loss, you determine the tax, you determine the incremental net working capital, like that. So that is what we needed to note at that point. Now, after we have determined that, we go to the next step, and the next step is to determine the incremental terminal cash flow. Determine the incremental terminal cash flows. Incremental terminal cash flows. The incremental terminal cash flow is equal to the incremental salvage value plus the incremental net working capital. We say that note incremental net working capital. Net working capital is a cash outflow when undertaking a project. Incremental net working is a cash outflow when undertaking a project, and a cash inflow at the end of the project life. I remember someone had asked this question, and I said I will respond to it at some point. So how do we get the incremental terminal cash flow? We say that salvage value of the new asset, salvage value of the new asset, we less salvage value of the old asset. This one, you get the difference. This is incremental salvage value. This is incremental salvage value, the salvage value at the end. Now, from there, we add incremental net working capital. We determined the incremental net working capital here as 2 million. So in our question, it would be there. Then from there, this is the incremental terminal cash flow. Incremental terminal cash flow, like that. This is the way to go about it, that way. Then, given this, let us determine from the above illustration. I'll just pick this one, and I say that from the above illustration, we determine that. Let us see how much it will be. So from the question, we are told that the salvage value of the new machine, when the new machine is acquired, it will be disposed at how much at the end? We are told that Economic life is 5 years and the salvage value is 6 million. The old machine was estimated to have a salvage value of 4 million. So he said that salvage value of the new asset is 6 million. 6 million. The salvage value of the old asset is 4 million. 4 million. The difference is 2 million. That is the incremental salvage value. Then we are told that the incremental working capital was 2 million. So how much is the incremental terminal cash flow? It is 4 million. Like that. That is what is expected, and that is what is the incremental terminal cash flow. Unless someone has a question, I can move to the next item. And the next item, we determine the incremental annual depreciation. We determine the incremental annual depreciation. Incremental annual depreciation. How do we get the incremental annual depreciation? It is the annual depreciation of the old machine, of the new machine, we less the annual depreciation of the old machine. How do we get to that? This is depreciation. We say that depreciation per annum of new machine, depreciation per annum of the new machine, we less depreciation per annum of old machine. So whatever we get here, this is incremental depreciation per annum. Depreciation per annum. Now let's go to our question again. We need to determine or to establish the depreciation per annum of the incremental depreciation. Let's get to that. So we say that from the illustration above, it should be, we say that from the illustration above, from the above illustration, let's take the depreciation per annum of the new machine. If you go back to the question, we computed the depreciable cost. This depreciable cost, this 18 million, this one. But at some point we are told that the new machine will be disposed at 6 million and it has an economic life for 5 years. So the new machine, depreciation per annum of new machine will therefore be equal to 18 million we minus 18 million we minus, it will be disposed at 6 million. 6 million like that, but it has an economic life for 5 years. It has an economic life for 5 years. How much is 18 million minus 6 million? Divide by 5 years. Is asking for an interpretation of 12075. Is asking 12075. Another one is asking about an overhaul. I thought we did an overhaul in the other illustration, in the last question. The overhaul, we talked about it in the other question, and we did everything, how to amortize it. That is why I didn't capture it in this question. Now, someone is asking about the 12075. The question is, what is that 12075? It is the money that is needed that this firm will go and source so as to succeed in acquisition of the new machine. In the replacement decision, you will get some money when you sell the old one, and there is the cost of the new one. So how much money are you needed to have? I see someone is giving me a depreciation at 2.4. I believe that is correct. The depreciation. Then we have the depreciation of the old machine. The old machine, remember, initially it was bought at 10 million, It was expected to have a salvage value of 4 million, and it was estimated to have an economic life of 4 years. So how much is it? How much was the depreciation per annum on the old machine? Okay, let me put it clear. This old machine has a net book value of how much? It has a net book value. We determine this net book value here. This net book value is 7750. It has a net book value of 7750. So if I could give this one as 7750 minus the salvage remain 5, but now it has a life of 5 years. How much will be the depreciation? 7750 minus 4 million divided by 5 years. How much is that? Someone is giving 1.5 million. How much is it? 750,000. Yeah, so I see like a majority are giving 750,000. Yes, 750,000. You depreciate the amount 750,000 like that. When you minus from the depreciation per annum on the new one, you get the incremental depreciation per annum. How much is that, please? $22.40 minus, is it 1650? I see someone has posted 1650, so I'll give it 50. It is 1650. That is the incremental depreciation per annum. Always remember to go about that. Unless someone has a question, we can go to the next step, and the next step is determine the incremental annual cash flow. Incremental annual cash flow. Determine the incremental annual cash flow. Now, when determining the incremental annual cash flow, what do we consider? We consider number one, incremental sales revenue. the incremental sales revenue, the sales will increase as a result of getting a more efficient machine. It is likely to cause an increase in sales. So as a result of this, sales revenue increases with less operating costs, less operating costs. Less operating costs, like that. Whatever we get from there is the earnings before depreciation and taxes. Earnings before depreciation and taxes, less incremental depreciation per annum, depreciation per annum. So this one, we less it. This will give us earnings before taxation, Then from there we less tax. Then once we get there, we get the earnings after tax. We add back depreciation, add back depreciation, This is the incremental annual cash flow. Incremental annual cash flow, like that. The incremental annual cash flow, that is what we'll be determining, and that is the way to go about it. Now, I want us to give an illustration. We say that suppose in the above illustration, the new machine will cause an increase in sales by let's say 6 million per annum with variable costs remaining constant, at 40% of the revenue. I want to change this one. I want to make this one equal to 12 million. With variable cost remaining constant at this much, and annual fixed cost will increase by let's say 3.6 million. per annum. Per annum. Or I said annual, so I don't need to repeat the word per annum. Required. Required. Determine the annual cash flows. Determine the annual cash flows. Let us look at this illustration. We try to work on it together. Number one, we are given revenue. The revenue will increase, and this will increase by 12 million per annum. This one will less operating cost, variable cost, and the variable cost is 40%. We multiply by the 12 million. How much is 40% of the 12 million? 40% of 12 million. Someone, is it 4.8 million? 4.8 million. 4.8 million. This gives the contribution. The contribution is how much? 9.2. 9.29. Is it 9.2? Then we less fixed cost. The fixed cost is 3.6. 3.6. We get earnings before depreciation and taxation. Can you confirm that 12.8 minus 4.8 is 9 point what? 9.2. Confirm whether it is 9.2. Then you minus 3.6. Oh, the contribution is 7.2. Where did I get 9.2 from? This 7.2 million. 7.2 million. Then earnings before depreciation tax should therefore be equal to 3.6. 3.6. We less depreciation. Depreciation per annum. Depreciation per annum. Earnings before depreciation and tax, we had determined incremental depreciation per annum. Incremental depreciation per annum was 1650. Less incremental depreciation per annum. Depreciation per annum. This is 1650. 1650. If I'm correct, it should be that way. I don't know. Yeah, can you confirm that that's the correct way? Then from there, we have the amount of earnings before tax. Earnings before tax. How much is it? How much is it, please? Earnings before tax. 1950. I see someone give me 1950. 1950, less tax, less. Remember we had given initially the tax rate was 30% tax. How much is the 30% of 1950? 585,000. Someone has given 585,000. 585,000. Then we have earnings after taxation. How much is the earnings after tax? Earnings after tax. Someone is giving 1365. 1365, like that. Add back depreciation, add back incremental depreciation. Incremental depreciation, I think it was how much? It was 1650. How much is the annual cash flow? Annual cash flows. That 15, that 15, that 15. That 15, like that. That is the annual cash flow, and that is what you'd be looking for. That is what you'd be trying to determine, like that. I want to squeeze it. Like that. Good. We have the annual cash flow. So the next item, after you have established the annual cash flow, is to determine the net present value. Determine the net present value, NPV, and help make the decision. So we say that from the above illustration, determine the NPV and advise the firm whether the replacement is viable. Let us try to determine the NPV, and we advise that the replacement is viable. Present value of annual cash flow. Okay, I am supposed to give given that the cost of capital is 9%. The cost of capital is 9%. So the present value of annual cash flow is equal to, the annual cash flow is 3015. This one we multiply by, we take 1 minus 1.09. This 1.09 power negative 5 years, because the economically the project has 5 years. Power negative 5, close the bracket, we divide by R, divide by 0.09. That should give us the present value of the annual cash flow. Present value annuity factor, 1 minus 1 plus R power negative n, divide by R, then you multiply by 3015. Can someone give me the cash flow, present value of the annual cash flow, please? Put that on your calculator, please. So how much is it? How much is it? Present value, someone is giving 11,727. Let me just copy the way it is. I'll put it the way it is. Then to this one we add present value of salvage value. Present value of the salvage value, or the terminal, let me use the word terminal cash flow of incremental terminal cash flow. Incremental terminal cash flow. Let me see the incremental terminal cash flow. We computed the incremental terminal cash flow. Incremental terminal cash flow, 4 million. 4 million. This one we discount at 1.09 power negative 5 years. Power negative 5 years. Like that. So how much is this? Present value of incremental terminal cash flows. Someone to put that in the calculator and give me the answer. $25.99. Another one is giving $25.66. $27.66. How much is the present value of the terminal cash flow? $25.99. Which is which? $25.99 or 27? I see another one, 25. Yeah, majority are giving $25.99. I'll go by $25.99. $25.99. We add, let's add this one. we add this one to, let me say 20. This will give us the total present value total present value cash inflow, present value cash inflow. So how much is 11,727 plus 2599? 725.54. Someone is giving 14,327 point something, 024. Yeah, 0.1. Like that. Then we less initial capital. The initial capital, we had an initial capital somewhere. We computed the initial capital together. Incremental initial capital, 12,075. 12,075. Like that. This is the net present value. The net present value, how much is that? Get me the difference. Get me the difference. Is it 2252,024? Good, like that. That way. So we say that the replacement decision is viable. The replacement decision is viable since it reads to a positive NPV, a positive incremental NPV, a positive incremental NPV. That is the way you go about such a question. That's the way you go about such a question on evaluating the decision as to whether it is viable to replace an existing asset with a new asset. It's called replacement decision. You evaluate the cost benefit analysis, you carry the cost benefit analysis, you determine whether it is a viable decision. And I think with that, everyone, unless someone has a question, maybe, I don't know, is there any question? If there is no any question, I want to move very fast to the next step because I want us to wind up. If there is a question, 1 minute, ask. Any question, any question? I don't see any question. No one has a question, and that is, I want to explain the next item. There's someone who is very determined on the tip to pass the exam, not to understand. Someone is saying that the way I'm determining the terminal cash flow is different from what you know. I will answer that one by saying that there are different ways of skinning a cat. So if you know a different way, it's okay. I cannot dispute. I cannot dispute. If you know a different way, I don't dispute. There are many ways of answering questions. So you could be having another way, which is okay, and which is equally correct. Now let me get to the next item. I get to the next item, and the next item is the issue to do with capital rationing. Capital rationing. I'm trying to move fast so that at least we can finish. Can someone tell me what is capital rationing? Uh, when there is insufficient, okay, before that, someone is asking, what about overhaul costs on replacement? See in the past paper. The overhaul cost, as I said, I had earlier in our earlier part, we discussed about the overhaul. I explained how you deal with the overhaul. You deal with it the same way, even in the replacement. Someone is asking me, don't use the annuity factor in the terminal cash flow. Terminal cash flow is a one-off cash flow. It is not annual. So we cannot use annuity on the terminal cash flow. It is not, it is a one-off. Yeah, I think those are the questions that I see. So the question is, what is capital rationing? Capital rationing. We have different arguments that people are writing. Allocating insufficient funds to the most viable project. The other one is sufficient fund to invest in projects. Choosing the best project to undertake according to the available funds. Capital rationing is when the company has insufficient to the potential investment. Yeah, you are all giving the same argument, which is correct. So we say that the capital rationing is the allocation of the available capital optimum to the viable project in case all the viable projects cannot be undertaken. You have so many projects that are viable. But now the capital is not enough. That allocation of the available capital optimally in the best way is what we call capital rationing. Capital rationing can be either. How do we classify the capital rationing? The classification of the capital rationing can either be, number one, can either be single period, or the rain here are heavy, very heavy rains. Single period and multi-period. Capital rationing. Single period and multi-period capital rationing. Then we have soft stroke internal and hard stroke external capital rationing. These are the classification of the capital rationing. The capital rationing is either the single period or multi-period capital rationing. Then we have soft or internal and hard external capital rationing. So single period capital rationing, single period capital rationing, we say that is the capital shortage over a period not exceeding 1 year. 1 year, meaning the capital will be available after 1 year. After 1 year, the capital will be available after 1 year. That is what we call the single period capital rationing. Now, a very important point, and which I don't want you to forget, because this is the basis of answering the question, we say that in case of single period capital rationing, in case of single period capital rationing, projects should be ranked using the profitability index. So as to determine the project to be undertaken immediately. For you to determine the projects that should be undertaken immediately in case of a single period capital rationing, considering that capital will be available after 1 year, meaning the project not undertaken will be undertaken after 1 year, we use profitability index to rank the project. Now, let me explain the multi-period capital rationing. I say that multi-period Multi-period capital rationing. Multi-period capital rationing is the capital shortage over a period exceeding 1 year, over a period exceeding 1 year, meaning the capital will not be available, will not be available even after 1 year, even after 1 year. In case of multi-period capital rationing, in case of multi-period capital rationing, projects should be ranked using the NPV. They are ranked using the NPV. This time, not the profitability index. The projects are ranked using the NPV so as to determine the projects to be undertaken. The projects that to be undertaken using the available capital, to be undertaken using the available capital. The projects to be undertaken using the available capital. That is the argument. That is the way to go about it. I don't know whether there is a question on single period and multi-period capital rationing before I explain the other capital rationing. Good. I don't see anyone with a question. Now, the other capital rationing is what we call the soft stroke internal capital rationing. Soft or internal capital rationing. What is soft or internal capital rationing, please? Someone to tell me what is soft or internal capital rationing. Soft or internal capital rationing. Let me see. What are you saying? Someone to tell us. I cannot see you responding. I hope we are still together. Let me know whether we are together, because here it is raining heavily. Can you hear me, please? Let me know whether you can hear me. Oh, yes, I see. You are there. You are there. Good. Thank you. Thank you. You see, when it rains, there are many things. If you can hear me, that is good. So let me explain what we call the soft or internal capital rationing. We say that it is the capital shortage. It is the capital shortage or insufficiency that is caused by factors within the management. Within the management control. Within the management control, e.g. unwillingness to borrow, unwillingness to borrow due to fear of the finance risk. risk. Someone decide that they will not borrow. They have the security, they have everything, but decide that they will not borrow because they fear financial risk. Financial risk. Due to fear of the financial risk. That is one. The other one, unwillingness. Unwillingness by directors. Unwillingness by directors to retain enough profit, to retain enough profit for investment. Instead they pay dividends. So the directors decide that they will not retain capital to invest. They go and pay all the money in form of dividends. They are causing shortage of capital. And the next one is what we call the external or hard stroke external capital rationing. Now, the hard or external capital rationing is the insufficiency of the fund. It is the capital shortage due to factors beyond the control of the management. Due to the factors beyond the control of the management, e.g., we say that the restrictive bond covenant, issued by lenders. You are willing to borrow, but now the lenders have made it so difficult you cannot borrow. The other issue is inability to float shares in the capital market for private companies. The inability to float shares in the capital market for private companies. You wish to do it, but because you are a private company, you cannot. You are restricted. You are unable. That is a factor beyond your control. So these are the issues that arise when it comes to the issue of capital rationing. I see someone had written that soft capital rationing. This occurs when the company itself chooses to limit the capital allocation to investment, and if external financing is available. Yeah, factors within your control. That is what we said. And that is what we call the capital rationing. I want us to look at more illustration here. We see whether we are in a position to respond to this. Let me get a small illustration somewhere. Good. Look at this illustration. Look at that illustration. The illustration reads, if you are there, if you can see my screen, I want to read through the illustration. The illustration reads, Kihingo Limited is considering 5 project proposals as summarized below. We are given project A, B, C, D, E. A, B, C, D, E. Initial investment. Let me replace this one with the Rwandan francs. We are given the Rwandan francs in million of Rwandan francs, like that. For each of the project, initial investment, annual revenue, annual fixed costs, the life of the project. Then down there we are told that the additional information, one, variable cost are 40% of annual revenue. Two, project D and E are mutually exclusive. Three, each project can only be undertaken once and each is divisible. C, 4, assume that the cash flow are confined to within, it should be confined to within the lifetime of each project. The cost of capital is 10%, no inflation exists, there is no risk, no tax exists, all cash flows occur at the anniversary date. Required. Assuming that the company has a limit of 40 million for investment in the project at time 0, determine the optimal allocation of the 40 million among the project and the resultant maximum NPV obtainable. Look at that question. We are given that information about the question. What is important first? Can you read that additional note? Read that part of the additional notes before we look at it. Okay, let us go to this question. We are told Kihingo Limited is considering 5 project proposals as summarized below. We have project A, B, C, D, E, initial capital annual revenue, annual fixed cost, life of project. Additional information, variable cost is 40% of the annual revenue. Number 2, project D and E are mutually exclusive. 3, each project can only be undertaken once and each is divisible. 4, assume that cash flow are confined to within the life of each project. Cost of capital is 10%, no inflation, no risk, no taxes. All cash flows occur at anniversary date. Assuming the company has a limit of 40 million for investment in project at time 0, determine the optimal allocation of the 40 million among the project and the resultant maximum NPV obtainable. This question, we are not told that it is a single period. So the assumption is, when you are not told, we assume that the capital rationing is multi-period. We are not told that the capital will be available after 1 year, so it automatically become multi-period. Let us try to work on it. Projects. We have project A, project B, project C, project D, project E. I think that is how they are. We got, for each of the project, we have the revenue. For project A, annual revenue we are given, annual revenue is 20, 30, 18, 17. 20, 30, 18, 18, I think the other one was 17, and the other one is 8. Is that 20, 30, 18, 17, 18, 8. 20, 30, 18, 17, 8. Good. We are told that the variable cost is 40%. We less variable cost. Variable cost. The variable cost for this one, what is 40% of 20? Is this 8? This one, 40%, I think it is 12. This one, what is 40% of 18? I don't know. I think it is 72. Please confirm for me. Then this other one, how much is that? 40% of 17, they said 68 something. Please, someone to confirm for me. 8, 12, 7.2, 6.8. Yeah, I see someone has given all of them. This is 6.8. Then we have 40% of 8. This is 32, I think so. Then you have the fixed cost. The fixed cost. The fixed cost me know. At what point did I get disconnected? I can see someone had written some 3200 there, so at that point I was still connected. I think it was just a breakdown. Can you hear me? Let me know whether you can hear me, please. Let me know whether you can hear me. Can you hear me? So I think someone says that I got disconnected on fixed cost. Oh yeah, then I had not moved. Yeah, you can hear me? Okay, I think it was just a breakdown and then it went back. Yeah, so if it is the fixed cost, then I think we have not lost anything. Because the fixed cost, this is the only thing that I have put here. And the fixed cost was from here. 5, annual fixed cost is 510,682. 510,682, 510,682, yes. And what we need to do is, can we get the earnings before depreciation and tax? Please give me the earnings before depreciation and tax for each. Earnings before depreciation and tax. Let me have that 20 minus 8 minus 5. Just give me the earnings before depreciation and tax. I see someone has written 7,000. Oh, so the first one is 7,000. What about the next one? Next one? I don't know whether that is 8. For project C, how much is it for project C? For project C, C is 48. C is 48. D. D is 22 and the E is 28. This one is 28. Like that. Now, if you go back to the question, we are told that there is no taxation. There is no taxation. Remember, if there is no taxation, note, since no taxation, ignore depreciation. Therefore, earnings before depreciation and tax is equal to annual cash flows. Since there is no depreciation, there is no taxation, we ignore depreciation, and therefore annual earnings before depreciation and tax is the same as the annual cash flow. Then we have the economic life. Economic life for each of the project is given in the question. For project 1, We are given 3, 5, 4, 10, 15. 3 years, 5 years, 3, 5, 4 years, 10 years, and he said 15. 3, 5, 4, 10, 15, 10, 15, 10, 15. So this one is 15. 15. Here we have the annual cash flows. These are the annual cash flows. These are the annual cash flows. This is the economic life. We need to determine initial capital. Initial capital. So the initial capital we are given in the question 10, 30, 15, 12. 10, 10, 30, 15, 12. 10, 30, 15, 12, 10, 30, 15, 12, and 18. E is 18. 18, 18, 18. Like that. Cost of capital. Cost of capital is equal to, we get this one from the question. The cost of capital is 10%. Do we have salvage value? We don't have the salvage value. No salvage value for any of the assets. So the cost of capital is 10%. Is 10%. So the tricky part there was to determine the annual cash flow. This one. This is the annual cash flows. That's the annual cash flow. That was actually the only tricky part. The annual cash flow. So since we have the annual cash flow, we have the economic life, we have the initial capital, we have the NPV. I want you to give me, I will have the project A, B, C, D, E, F. The project, I want you to give me the NPV. You have the annual cash flow, economic life, initial capital, cost of capital. I want to give you some 5 minutes, no, 10 minutes. Give me the NPV for each. I'll give you 10 minutes. Compute the NPV so that you assess whether you understand. Give me the NPV for each of the project, please. 10 minutes. See how much you've gotten as the NPV for each. I believe I have given enough of time. The NPV, can I have the NPV for each? Let me have the NPV for each. I need the NPV for A. The NPV for A. What is the NPV for A? Please. Can I have it? Can I have it? That question was so direct. Can someone send the NPV for A? NPV, please. Share NPV for A. Is it the one that someone is sending as There's someone who has said 7408. Is that correct? Is the 7408 correct? Let's have the one for B, then PV for B, NPV for B, NPV for C. B, someone is giving 326. 326. I don't know whether it is correct. For C, how much is the NPV for C? C is 215. I see someone has posted 215 for C. C. C, someone is giving that 297. I don't know whether it is correct. That 297. I don't know whether that is correct. That is a D. Is it D or E? I think E. What about D? D is how much? 3297 is E. So D is how much? Is D 15? 1518? Someone has given 1518. Since this is a multi-period, we rank the project. The best project should be number A. We call it number 1. The next project E is number 2. The next project is number D. We give it number 3. B, we give it number 4. I don't know whether that is correct. And this one we give number 5. Can you confirm that those rankings are correct and your computation are consistent with what we have given? Can you look at it? We confirm. We are told that there is available 40 million. We need to allocate the 40 million. We have available 40 million that need to be allocated. So we say that capital available, the capital available is 40 million. We start with the first project. We start by undertaking project A. Project A. Project A How much is the initial capital for project A? It is 10. 10. Once project A is undertaken, how much would be the remaining amount? We are left with that, like that. Then we go to project number 2. Remember in the question there is this statement. Look at additional note number B, 2. Project B and D and E are mutually exclusive. When projects are mutually exclusive, they cannot be undertaken together. You undertake one, you leave the other one. So you undertake one, you leave the other one. Now, D and E, which one comes first? Let's first check which is project number 2. Number 2 is project E. So what we say is that undertake project E. Project E. Okay, let me try to squeeze this. Project E. What is the capital for project E? Project E capital is 15. 15. Like that. How much is remaining? It's 15, if I'm correct. Then the 15 is available to undertake the next project, and the next project is D, is 30. But we only have 15. Go back to the question and check this statement. Statement number variable cost project is project. Assume that the cash flows are confined, the cost of capital, no inflation, no risk. Are we told about, yeah, note number 3, each project can only be undertaken once and each is divisible. Each is divisible. If it is divisible means B, there is available 15 million, and it requires 30. So it requires 30. But the capital available is 15. Since it is divisible, we invest the 15. And as a result of that, we will get to a balance of 0. So we can therefore say that undertake project A and E fure and 15 out of 30, which is equal to 50% of project B. We undertake A fure, we undertake B fure, and we invest 15,000 available in project B. So we undertake 50% of project B. The other question that you are required to determine, net present value. Can someone give me the total present value obtainable? The total present value, the total NPV obtainable from this question. Someone to give me this. Someone to give me this, please. Compute and give me the total NPV obtainable. Someone is asking whether we rank them based on NPV. Yes, we rank them on NPV. Just 12 over 30, please. 12 over 30. Thank you. Thank you for that observation. Thank you for that observation and the correction. I think this one is 40%. I believe it is 40%. 40%. So how much is the combined NPV if that is correct? If the 40% is correct, how much is the combined NPV? What is the NPV of this investment? I'm waiting for the answers. I don't know whether someone is giving 12,765. NPV, how much is the final NPV? NPV for A is 7,408 plus we undertake project E-Fure E 3297 undertake 40% multiplied by B. B is how much? 326. How much is that? How much is that? I think that is what you used. 10,837. Is it 837 or 835? 10,835.4. Yeah, so that is it. 10 like that. That is what would be required in that question. And that is the capital rationing. You can have it now set in a way where you are required to do 1 year. The capital rationing in 1 year, just rank it the way we have done, but this time use profitability index. Use profitability index. And because of time, I want us to wind up with the conflict between NPV and IRR in project evaluation. Let me say that the conflict between the NPV and IRR in project evaluation, we say that in some cases, NPV and IRR ranks mutually exclusive project projects differently. Ranks mutually exclusive projects differently. In some cases, NPV and IRR ranks mutually exclusive projects differently. So, like for example, we could have a project. Let's say example. You are given project. Let's say project A, and you have project B. Then you are told that this is the NPV. Maybe the NPV for project A is 120. Then the one for project A is 150. Like that. So if you are to rank this project by NPV rank, you would say that this is the second and this is first. But now, when it comes to the ranking using, or when you compute the IRR, maybe you find that the IRR for this one is 12%, while the IRR for this one is 9%. So when you come to the ranking using the IRR, ranking using the IRR, you will rank this one as project 1 and you rank this one as project 2. So when you look at this, it automatically puts you in a situation where you don't know which project would you undertake. NPV says project B, IRR says project A. This is what we call the conflict in ranking between the IRR and NPV in project evaluation. We say that in case of conflict, in case of conflict, the NPV ranking should prevail. Since it is consistent with wealth maximization goal of the firm. The shareholders are about what they will get. So in case of such ranking conflict, the NPV ranking should prevail. It means that we are concerned about the wealth maximization of the shareholders. Now, causes of conflict. What causes the conflict? Number A, there are all four circumstances or four scenarios that you can say that they cause the conflict between IRR and the NPV. There are four scenarios. Cause number one, in case of difference in size. In case of difference in size of mutually exclusive projects. In case of difference in size of mutually exclusive projects. Example, we are given two projects A and project B. Then we are told that initial capital, we are told that the initial capital for this project is 1 million Rwandan francs, like that. Then you have project B, its initial capital is 100. You see, when you look at this one, they are mutually exclusive, but they are different in size, the initial capital. Let's say economic life, we take this one is 1 year. They are similar. They got 1 year, like that. Then we are told that the annual cash flow, the annual cash flow at the end of the 1 year of economic life At the end of the 1 year of economic life, this one is 1.2, like that. But it is, sorry, but this other one has an 150, like that, that way. Then you are further told that the cost of capital, the cost of capital is 9%. Then required, determine the IRR and NPV of each, the two projects. I want us to look at this small illustration. Good. Let's look at this small illustration. We are told that here are two projects, Project A and Project B. Initial capital of A is 1 million. At the end of the year, it will have 1.2 million. B is 100. At the end of the year, it will have 150. What is the NPV? Let us take it this way. A project A. Project A. Project A, we say that NPV is equal to 1.2 million. We multiply by 1.09 power -1 because it has 1 year minus 1 million. How much is the NPV, please? How much is the NPV? Someone to give me the NPV for this. NPV, put it in your calculator and give me the answer, please. NPV of A? $108.80. 109.17, which is which? 109.17. Let me go by that. That one got majority. So the NPV is here, and you say that is the NPV for project A. Can we determine the IRR? IRR for project A is equal to, we say that it is the future value divided by present value minus 1, which is equal to, the future value is 1.2 million divided by 1 million, then you minus 1. How much is the IRR? 1.2 million divided by 1 million minus 1. That one, if I'm not wrong, is 20%. That is project A. Let's go to project B. Project B. Project B, NPV. is equal to 150 multiplied by 1.09 power negative 1, because it is 1 here, minus 100. How much is the NPV for project B? Project B, someone to give me the NPV for that project B. How much is it? Is someone giving 37? 37,615. 37,615. That's what I see. IRR for B. IRR for B is equal to the future value 150 divided by 100. You minus 1. This is 50. 50%. 50%. Let's have a summary. Summary. Project. A, B, let's see, NPV for A. NPV for A is 100, 917. B to something like 37. 37,615. So we say that rank. This one is the best. This one is the second. IRR. This is 20. Was it 20%? And this one is 50%. If you are to rank, this one becomes number 2. This one becomes number 1. That is what we call the conflict in ranking of the NPV and the IRR. That is scenario number 1 in case of difference in size of mutually exclusive projects. Difference in size of mutually exclusive projects. The next one, that was number A. Let's do number B. Number B. B, we say that in case of non-conventional, in case of non-conventional cash flows, in case of non-conventional cash flows, when do we say that cash flows are conventional, and when do we say that the cash flows are non-conventional? That is the question that we need to respond to. When do we say that cash flows are conventional, and when do we say that they are non-conventional? We say that cash flows are conventional if there is an outflow when undertaking the project followed by inflows during the project life. For the conventional, the non-conventional, if I could put it here, cash flows are non-conventional if there is an outflow when undertaking the project, followed by inflow in some years, and outflow. This is negative cash flows. It's negative cash flows. Project followed by inflow in some years and outflows in other years during the project life. Let's say consider the following. You are given years. The project life is, let's say you have a project with 6 years. Then you are told that let's even have year zero. Then you have project A. You have project B, like that. Project A, the cash flows, let's say it's 1.2 million, like that. And project B is 1.2 million. Both of them are the same. But now in project A, year one, you expect that it will generate 30,000. Project B will generate 78. You go to year two, this one generate 45. This one generate 16. Year three, this one generate 54, or this one generate negative 23. In year four, this one generate 62, or this one generate something like 112. This one generate 75. This one generate 96. Then in the last year, this one generate 80, maybe 80. This one generate negative 12. So when you look at project A, we say that project A cash flows, are conventional, while project A, B, cash flows are non-conventional. If you could determine the NPV of these two projects, they are likely to be ranked differently between the NPV and IRR. But we say that in case of non-conventional cash flows, non-conventional cash flows, there are two possibilities. There are two possibilities. There are two possibilities. Possibility number one is that there is no IRR at all. No IRR at all. Number two, multiple or more than one IRRs. More than one IRRs. So these are the likelihoods. In case of non-conventional cash flow, you are likely to have more than one IRR, meaning you don't even know which one to use. The other possibility is you try to compute the IRR, you cannot compute. You are unable, there is no IRR. That is what we talk about the non-conventional cash flow. It brings conflict in ranking of the project. Number C. I don't know whether there is a question so far before we proceed. So number C, we talk of in case of difference in timing of cash flows. In case of difference in timing of cash flows, the difference in timing of cash flow, this is about the cash flow pattern. The cash flow pattern. We say that mutually exclusive projects may have different pattern of cash flows. Different pattern of cash flow timing. Different cash flow timing. For example, I want us to have projects. Let me say years. 1, 2, 3, 4, 5. Possibly I should have started with an year 0, like that. So what I have here is project A. Project A in year 0, it called for 1.2 million. 1.2 million. That is the initial capital outlay. The cash flow in year 1, we are told that it is 35. The cash flow in year 2, maybe you are told that it is 42. The cash flow in year 3, We are told that it is 56. The cash flow in year 4, we are told that it is 64. And the cash flow in year 5, we are told that it is 68. Like that. When you look at these cash flows, the cash flows are increasing. Then we have project B. Project B. Project B. The difference in pattern. The project initial investment is the same. But when it comes to the pattern of the cash flow, project B has maintained a constant annuity of 55. A constant annuity, 55. 55. Such projects are likely to cause a conflict when you are ranking them, when the cash flow pattern is different. Or you could be having another one, the cash flows are decreasing towards the end of the project's economic life. So there are all those possibilities, the timing, difference in timing of the cash flows generated by the project, by the mutually exclusive projects. And the last one, the last scenario is where we talk about a difference in economic life of mutually exclusive projects. We say that difference, we say that in case of difference in economic life of mutually exclusive projects. So in case of difference in economic lives of mutually exclusive projects, in case of difference in economic lives of mutually exclusive projects, you have one project, it has 5 years of economic life, the other one has 10 years. The life is different. When mutually exclusive projects, when mutually exclusive projects have different economic lives, there are possibilities of conflict in ranking, between NPV and IRR, between NPV and IRR. The solution for this one, there is a solution. The solution to this problem, the solution to this problem is number 1, Roman 1. Let's say A undertake the project repetitively undertake the project repetitively over the LCM of the economic life. We say that this makes the LCM of the economic life the evaluation horizon. The evaluation horizon. We say that example, if project A has an economic life of 3 years, and B has an economic life of 4 years, then the LCM of the economic life is, what is the LCM of 3 and 4? Someone to help us. What is the LCM of 3 and 4? The LCM of 3 and 4. Someone to post for us. Lowest common multiple is the LCM. Yeah, someone has responded. Someone had asked. So, the LCM, yeah, I see people are saying 12. Yes. LCM is 12 years. The LCM for 3 and 4 is 12 years. Is 12 years. 12 years. So this means that project A can be undertaken repetitively. For how many times? 3, for 4 times. If you undertake it, you get to the end, you undertake it again for 4 times, adding up to 12 years. Project B can be undertaken repetitively. Project B can also be undertaken repetitively for 3 times. You take 4, again 4, adding up to 12 years. Both will have a standard life of 12 years, which is the LCM. That is what it means when the projects have different economic lives. We can use the LCM. The other option is Number B, we use annuity. We call it replicated annuity equivalent value. We use the replicated annuity equivalent value. We say that this applies when the life of the project is too lengthy. Lives of the projects are too lengthy. E.g. project A is equal to, let's say, 9 years, and B is equal to 13 years. The LCM is too high. The LCM is too high. It is therefore better to undertake the projects repetitively in perpetuity. Instead of over LCM, instead of over the LCM. So you assume that this project will always be there. You don't use the LCM. You assume that now you have the project, they will be there forever. That is the annuity equivalent. You take the project like they will be there forever. This applies. Yeah, you assume that they will always be there in perpetuity. We call it annuity equivalent value. You undertake again and again in perpetuity. So in simple terms, you are earning the cash flow, the annual cash flows in lifetime, over perpetuity, not lifetime, over perpetuity. So that is the argument to do with the conflict. In case you are told to give the conflict between the NPV and IRR, I have cited the fourth scenario, and which I believe that I have tried to explain. So I want us to leave it at that. Tomorrow I want us to deal with the questions. We deal with the questions as we wind up those series of classes. It has been tough, sacrifice, but the sacrifice was worth it. The good thing is that we did not miss even a single lesson. Maybe on your end, I don't know whether you attended all, but for me, I have been able to be present in all the lessons, and sometimes it call for sacrifice. That is why I wonder why students don't sacrifice. I can imagine I have been very busy with a very busy schedule in a foreign country, but still I make sure that I attend your classes. But there are people with a slight reason not to attend, they don't attend. and you are the one who is sitting the exam. For those who have sacrificed, thank you. I see you are at 66%. Unfortunate because a very big number is not present and someone will give a reason. I also had enough reason to say that I am very far, I don't know what will happen, but I decided to do it. Have a great evening. See you tomorrow.